As we start the new year, there are a lot of signs on the financial markets that 2023 could be a very unstable year for the economy. In particular, there are concerns about the possibility of a recession, the health of the housing market, and the potential for inflation to rise. To start, let's take a closer look at the probability of a recession. According to the National Financial Conditions Index from the Chicago Fed, the risk of a recession has grown in recent months and is getting close to neutral. Also, surveys of economic forecasters and commentators show that the likelihood of a recession in the next year is growing. But it's important to remember that the length and timing of a possible downturn can vary a lot. While the risk of a recession is cause for concern, it's important to also consider the state of the housing market. Corporate credit spreads have tightened to begin the new year, and profits as a share of GDP have remained at record levels. However, the Federal Reserve's aggressive interest rate increases are taking a toll on housing markets. Together, this and the uncertain state of the economy could have an effect on the housing market in 2023. Finally, let's turn our attention to the potential for inflation. The year-to-date global default tally through November stands at 82, compared with 55 defaults for the full year 2021. Also, Moody's credit transition model says that the rate of default will rise to 2.9% by the end of 2022, which could cause inflation to rise. As we can see, there are a variety of factors to consider when looking at the economic outlook for 2023. While there are certainly concerns, it's important to keep in mind that the situation is constantly evolving and that there are steps that can be taken to mitigate potential risks. Let's dive deeper into the data and take a closer look at the specific factors that are contributing to the economic climate in 2023. As we dive deeper into the economic outlook for 2023, it's important to take a closer look at the probability of a recession. While the consensus among economic forecasters is that a downturn is likely to occur, the timing and severity of this recession remain uncertain. However, there are a number of indicators that can give us an idea of what to expect. One key indicator to consider is the yield curve. The yield curve is the difference in interest rates between short-term and long-term bonds. Typically, long-term bonds have a higher yield than short-term bonds. However, when the yield curve inverts, it means that short-term bonds have a higher yield than long-term bonds. This is often considered a leading indicator of a recession, as it suggests that investors are more concerned about the short-term economic outlook than the long-term one. Currently, the yield curve has been flattening, with the spread between the 2-year and 10-year Treasury yields narrowing to just 0.11% as of January 2022. Even though it hasn't yet turned negative, this is a worrying trend that could mean a recession is coming soon. Another indicator to consider is the labor market. The unemployment rate has remained low in the past year, but it has started to tick up in recent months. This could be an indication that the labor market is starting to weaken, which could lead to a recession. Additionally, we also need to take a look at the housing market. As we know, the housing market has been on a tear in the past year, with home prices and sales reaching record highs. However, there are signs that the market is starting to cool off. For example, The Housing Affordability Index from the National Association of Realtors has gone down in recent months. This means that housing is becoming less affordable for the average consumer. This could lead to a slowdown in the housing market, which could have negative effects on the overall economy. Lastly, let's take a look at the inflation rate. The Consumer Price Index, CPI, has been on the rise, with the annual rate of inflation reaching 2.6% in November 2022. Even though this is still below the 2% goal set by the Federal Reserve, it is a worrying trend that could lead to higher interest rates and a tighter monetary policy. This could have negative effects on the overall economy and even lead to a recession. In summary, while there is no clear consensus on the timing and severity of a potential recession, a number of indicators suggest the possibility of a downturn in the near future. It's important to keep an eye on these indicators and be prepared for any potential economic challenges in the coming year. As we delve deeper into the economic data, it becomes clear that the housing market may also play a significant role in the economic outlook for 2023. According to the National Association of Realtors, sales of already built homes dropped by 2.9% in December, while the median price of a home went up by 15.8% from one year to the next. This shows that the housing market may be slowing down, which could be because mortgage rates are going up. Also, the building of new homes has slowed down. In December, housing starts fell by 7%. Also, the building of new homes has slowed down. In December, housing starts fell by 7%. But it's important to remember that the housing market isn't a single thing, and different parts of the country may be going in different directions. For example, the housing market in big cities might be slowing down, but the market in smaller cities might still be growing strongly. Also, the luxury market has stayed strong, and high-end homes are still selling quickly. One factor that may be contributing to the cooling of the housing market is the lack of inventory. The number of homes for sale has stayed low, which has made the market more competitive and caused prices to go up. This could be because of a number of things, such as the lack of new construction and the fact that homeowners are hesitant to sell in a market with so few homes for sale. Another factor to consider is the impact of rising mortgage rates. The average rate for a 30-year fixed mortgage has risen to 3.03%, the highest level since May of 2020. Some people may be hesitant to buy because their monthly mortgage payments will go up because rates are going up. However, it's worth noting that rates are still historically low and may not necessarily be a major deterrent for many buyers. Overall, the housing market in 2023 is likely to be a mixed bag, with some areas experiencing cooling while others may continue to see strong growth. The lack of inventory and rising mortgage rates are likely to play a role in shaping the market. But it's important to keep in mind that the housing market is a complex beast and there may be other factors at play as well. As we've seen, the economic outlook for 2023 is a complex and multifaceted picture. Even though there are risks and possible problems to deal with, there are also a lot of good signs and chances to grow. In order to make the most of this year, it's important to stay informed and attuned to the latest data and trends. This means staying up to date on the latest economic indicators, such as GDP, inflation, and unemployment rates, as well as monitoring the housing market and credit spreads. Also, it's important to have a good plan for your money and be ready for a recession, if one happens. This means making sure you have a diversified portfolio, an emergency fund, and are aware of how you spend and save your money. Overall, the key takeaway from this analysis is that while there are certainly risks to be aware of, there are also many opportunities for growth and success in the year ahead. So stay informed, stay prepared, and stay optimistic about the future. In conclusion, I would like to remind you that this video is just a small part of our channel. We have many other videos that will help you understand more about the economy, personal finance, and investments. Please consider subscribing to our channel and hitting the notification bell to stay updated. Thank you for watching.